So a trust itself, just taking you like you don't know anything, a trust is a contractual relationship between three people, right? So you got a grantor, a trustee, and a beneficiary. The way that we do this is we would name you the trustee here. Either you could find a relative that would never be a part of the trust, like a cousin or a grandpa, something like that, or we actually offer a settler service through a law firm that we work with. So that would be your grantor, you would be the trustee, and then in your specific case, it sounds like your son and your wife would both be beneficiaries for you. How we actually set our trust up and what makes us different, right? So we have non-grantors, right? So what a non-grantor trust actually means is the grantor is resigning, right? So they create the trust theoretically, they sign it over to you, the trustee, and then they just wipe their hands clean of the situation. The second pillar that our trust stands on is we make it irrevocable. The reason that we make it irrevocable is because the state, the IRS, they look at an irrevocable trust as its own individual sovereign entity versus if you get a revocable trust, they're going to just look at it as an extension of debt. And so the key with this is you're selling your assets, like your house, your vehicles, you're actually selling those assets to the trust. So now the trust is the owner. And the reason that's crucial is because let's just say you get in a wreck, right? It's your fault. Alexander Shannara comes after you. Well, he can take your house and everything else you own because it's in your name. So when we do this, we're actually completely removing that liability. So Alexander Shannara can still come after you, but there's nothing to take. Next, we set it up non-statutorily, right? So what that means is we set it up based under common law and under Constitution. So our trust is directly derived from Article 1, Section 10 of the Constitution, which is your right as an American to actually privately contract. And the reason that that's so crucial is, and a lot of attorneys would be like, well, a traditional irrevocable trust cannot do the things that you say it can do, like defer taxes and some of the things that we're going to talk about. But because it's set up as a common law trust, it actually does have that ability. And the Supreme Court has ruled in favor of common law trust literally hundreds and hundreds and hundreds of times. So we have just a laundry list of case laws that support our trust. And then we set it up complex. It refers to end of the year distributions as opposed to being more or less complicated, right? And so the opposite of complex would be simple. And so with a simple trust, you're required to distribute all the assets, like all the leftover cash. You'd be required to distribute that to beneficiaries, which would create a taxable event, which we don't want that. So we're complex, meaning that trust actually retains all that cash at the end of the year. We have discretionary. So discretionary means you as the trustee are going to have 100% discretion and authority over all the trust assets, what they do. So this is like truly like John D. Rockefeller, own nothing and control everything. This is what's giving you that ability. And lastly, spendthrift. So spendthrift provision means that the trust is protected from anything that the beneficiary does or anything that the trustee does, right? So let's just say, again, that same Alexander Shannara scenario, he can't come after your trust because of that spendthrift provision. It truly creates a separation between you and the trust. Now it's still discretionary and you're still managing, but you don't own anything. So whether it's lawsuits, creditors, God forbid, right? But like for some people, like divorce. So like if a beneficiary, let's just say somewhere down the line, grandkids, whatever, their spouse, they could benefit from the trust through the beneficiary, but they can't come take a piece of the trust, right? So it's truly protected. Much like before, same situation, right? Right now, this is how most people are set up. Maybe there's an LLC or a 1099 involved, maybe not. But right now, you own everything, which means any liability is on you. Any lawsuits that come after you, everything is at risk. And any creditors, let's just say, sometimes stuff happens, right? You default on a loan. Well, now, whoever, Bank of America, is trying to come after your house with a lien because you defaulted on that loan. So right now, all of that is at risk to those scenarios. So what we do is we actually go ahead and we create a family or a dynasty trust. So the big prominent American families, the Rockefellers, the Kennedys, the Trumps. Like, this is what they have, and this is how they hold their assets, and this is how they create, multiply, and preserve wealth. So again, just like we spoke about before, you're the trustee here. Wife is the beneficiary, and for you, you only have one son, so your one son would be the beneficiary in this instance as well, right? And again, it's 100% complex, so you don't have to distribute assets, and it's 100% discretionary, so you get to choose. So just because he's the beneficiary, that doesn't mean that, you know, you're gonna be paying him out distributions or anything. That just means that, you know, he can benefit at any time from the trust. So the first thing that we do, let's just say you signed up today, we create this trust, right? And then we go and we, you know, for you and for the people that it makes sense for, we create a business trust, right? So this business trust is going to handle all of your active income, right? So, you know, your job, whatever you got going, 1099 contracts, it's going to handle all of your active income. If you have an LLC, we don't recommend this, but if you do have an LLC, or if you're in a business like HVAC, refrigeration, where you have to have an LLC to buy refrigerant, then you would just make the business the majority partner in this LLC. And then you would just do K1 distributions, passing this money into the business trust. And then the last thing we do is we set up a 508c1a trust. So the key with that 508c1a is it does a few things for you. Number one, it protects all your religious freedoms, right? So again, Article 1, Section 10 of the Constitution, your right to privately contract. The IRS refers to a 508c1a as one of three things: an unincorporated association, an association of a church, or a private membership association. So it falls into one of those three categories. And essentially, what that means is it could be a legitimate church if you wanted it to be, or it can just be a private association founded on whatever beliefs that you want to have, right? So like this could be, if you wanted to found it on, hey, you know, we love to shoot guns and we love, you know, self-defense and freedom. Well, you could absolutely found this particular 508c1a on those principles. And so what's really cool is actually yourself, me, anybody else can actually join you. You're still the trustee, so you still maintain control, but just like a church or at any other association, we can actually join and become members. And so what's also really cool is this can also even be like a private school. And so where like the practical application of it being a school is, so even like the Christian in the private schools, like during COVID, when the government was mandating shutdowns, forcing people to wear masks, because you're not required to register with the state and you're operating under common law, not legislative law, which is myriad of rules and regulations according to the Supreme Court, you actually, you know, would get away with, hey, we don't have to cancel what we're doing, so we can keep doing business with our members. We can keep bringing kids to school. We can keep getting together. We can keep going to the gym. However you have this structure, you get to keep on trucking, despite the fact that all the legislative entities like the 501c, the traditional 501c3s that are incorporated, LLCs, S corps, C corps, despite the fact all those entities are getting shut down due to, you know, COVID mandates or whatever, you actually would be able to just continue operating under that, under the guise of the 508c1a. So that's where that really comes in. And then there's one more key piece that I'm going to tie in here in a second. So let's just say we get all that. We're going to create those three trusts. Then once we create those three trusts, the first thing you're going to do if you were to work with us is you would sign up with our accountant, right? We include the accounting fee. We go ahead and take care of that for the first year. She's $6,000 for the first year. We go ahead and pay that for you. And then you would be, every single year, you would have a maintenance fee, whatever, $1,000. And you'd probably be $1,000 for the business and $1,000 for the family. But you know, you're going to pay an accountant anyway, right? So that's just kind of a necessary expense. But what we would do is you would go with her and you would get with our back end team and we would begin to transfer your assets, right? So we would do a quick claim deed on your house, so what's really cool about a quick claim deed is it doesn't guarantee the status of a lien, but it does guarantee ownership, right? So your house is still protected despite the fact that, you know, Dale and his wife have a mortgage on the house. The house is actually in the trust. And what's better than that is now the house is a trust asset. And so the trust can pay for any expenses that are related to the trust assets, right? So your mortgage, your water bill, your power bill, you're paying all of those expenses with pre-tax money, just like you would in a business. And then obviously, same thing with your car. We move the car into the trust. So like now your title will say XYZ Trust. It'll no longer be yours, but again, you're the trustee, so you have full discretionary. Nobody else can come back and take anything. You're managing everything. So now you're paying with pre-tax money, you're paying for oil changes, tire rotations, new tires, car, windshield gets cracked. You're paying for all those expenses with pre-tax money. Additionally, any money you have in savings, you'll go ahead and move that over there as well. And then your life insurance policy, depending on how we structure it or what we do, but most likely you'll go ahead and move that over as well. And I'll come back to the, for you, you have a 401k, but it's a qualified plan. So I'll come back and show you how we work that. On the business side of things, we have your actual business. That goes over here. All of your active income, all that's going to go in the business trust and come down through the business trust. And then, all your work, that's going to go in there as well, right? And then the 508c1a, whether it's a church or other similar entity, or it's founded on guns, whatever you decide to found it on. And then additionally, education. And then of course, your family and anybody else you choose can be members of this trust. And then on top of that, you can receive, so with the 508c1a, on the tax side of things, so under Article 508c1a, you are exempt from registration. Under IRC 26-6033A3A1, you are exempt from filing taxes. So this situation is completely and 100% tax exempt. So I could actually right now, let's just say you had your 508c1a, I can literally wire you $50,000 and you can give me a tax deductible receipt for my own personal taxes, or let's just say my business trust taxes. You can give me a tax deductible receipt. You get the money tax free and I get the donation, just like if I was to donate it to a church or another charity. So like really the 508c1a is like truly the epitome of the freedom that you thought you had as an American. And now for the taxes, right? This is like, how does it all work? Okay, like you've told me about it. It looks great, but what does the IRS say? How does the money ebb and flow, right? So again, what we do here is all of our active income is going to come in through the business trust. So examples of active income, 1099, anything like that you're doing, that's all active income. All of our passive income is going to come in through the family trust, right? So that's passive income is grouped together. So that's going to be anything like rental agreements, lease agreements, dividends, or capital gains are actually also considered passive income. So the way that we do this is our active income comes in through the business trust, right in through here. Then you're going to have your legitimate business expenses, right? Whatever they are in your business. Maybe it's a gross profit of 100,000 and then you have 20,000 in legitimate expenses, right? So it's not like an LLC where you need to go try to make stuff up to write off and like get in the gray area and hope you don't get audited. We don't do any of that. You're going to have your legitimate stuff, right? So you're left over with 80,000. So this business trust is taxed at a 37% rate right here. What we do is just like with an LLC, we would go ahead and we would distribute that 80,000 to the family trust. And so that distribution is considered a dividend. So it would fall into passive income, right? So we turned it from active income and we turned it into passive income through that distribution. So what we actually do here is govern under IRC 643. That's the specific tax code that allows us to do this, right? So this distribution is considered an extraordinary dividend under IRC 643B. And Then you have passive income, right? So now we have this $80,000. We have it sitting in our business, or excuse me, we have it sitting in our family trust, that 80,000, right? So let's just say you have our distribution of 80,000. Additionally, let's just say you had some stocks or some crypto, or you sold some property, whatever happened, and you have another 20,000 in passive income, right? So your total net is going to be, you had $100,000 in income come into your business trust. Now, this family dynasty trust is also taxed at that same 37% rate traditionally, unless you know what to do with it, right? Luckily, we have an accountant. She's been doing this, filing these types of trusts for 30 years, 1041s. She's done over 12,000 of them and has never been audited, not one single time. So she truly, she's the best accountant. And that's why it's kind of more or less mandatory that you work with her, right? Because you go down to your local accountant, they're going to be a little bit confused when you start trying to explain all this to them. So what we do from here is, now we have our trust expenses. So this is where you start initially saving money, right? Let's just say the mortgage is $2,000 a month, roughly, give or take, for easy numbers here. We'll go $25,000 in mortgages, $10,000 in car maintenance, and another $5,000 in, miscellaneous expenses, things of that nature, just for easy numbers here, right? So you're left with $60K. Now, so what do we do with that $60,000 to ensure that you don't pay 37% taxes, 37% of that in taxes? What we do and how we make this work in our best interest is we actually defer that $60,000 in perpetuity, right? And so perpetuity just means basically forever. And so the IRS code that actually backs this up is IRC 643, and then A3 is the one, and section B. Those are the two sections that allow us to do this. And basically what they say is, and this is why it was so important that our trust is set up as complex and is not required distributions, is because what we do is we actually allocate it to corpus. And so corpus is just the body or the principle of the trust. So all that means, all we're saying here is Dale is not going to take a $60,000 distribution, and the beneficiaries of the trust are also not going to take $60,000 distributions, right? We're going to put this right back in the trust. That's all we're doing with it. We're putting it in the trust bank account, and that meets the definition of allocating it to corpus or to the principle of the trust. And so then we have the ability to defer those taxes. Now, you can defer those taxes in perpetuity. You can just keep doing that, literally, forever. But what we do, and what really drives this thing home, is we actually set up whole life insurance. And we do it in such a way that you can use this like a short-term savings vehicle, right? So with whole life insurance, the way that we set it up, what it allows you to do is, let's just say you have a single premium whole life, and you put in $100,000 into that single premium whole life. Well, it's not like car insurance where the money's just gone, you didn't wreck the car, so you didn't get to use the insurance. So there's a reason they call it life insurance, not death insurance. So traditionally, before 1988, when the tax rules got really super strict, the wealthy used whole life insurance as a short-term savings vehicle, right? So you can put $100K and get a guaranteed 5 to 10% interest on this every single year. And what's really cool is, and this is where infinite banking comes from, is at any time within about a span of about 5 days, let's just say you put this $100,000 in there today. Well, by next Tuesday, you can actually go and you can actually take a loan against that at 97%. 97% of what you put in there at a 3.5% interest rate. So, and here's where things really come home and where they really click. Well, you're getting, we'll call it 5% interest on $100,000. And you just took a loan on $97,000 at 3.5%. So even if it was an even 100 right here, and you can get all of it out, which after a couple of years, you can get all of it out, you're profiting 1.5% here to have this money in there. So you're getting 5% interest, you're paying 3.5 to have it out of the policy, but it's a loan, you didn't actually withdraw it. So you're netting positive 1.5% on this situation right here. So because we set the whole life insurance up as an expense, as an asset on the trust books, that you can actually use this 60,000, put it into the life insurance policy, start gaining 5% interest on money that would have otherwise been sitting in your savings or checking account, earning you nothing, all while still having access to it at 3.5%. But again, you're netting the 1.5. And what's really cool is, let's just say something happens and you couldn't pay this back. Well, this $100,000 still has, let's say, a $2 million death benefit attached to it. So if you die tomorrow and can't pay it back, well, the $97,000 loan that you took out gets paid off when this $2 million distribution gets paid back into your trust 100% tax-free. So now that's all the trust expenses. And so it's very key. And a lot of people will tell you, kind of some of the misinformation on the internet, TikTok, whatever, is that, well, the trusts don't pay any expenses and you can live out of the trust and all this kind of stuff. So there's 3 things that the trust cannot pay for, okay? Those 3 things are food, fun, and fashion for trustees and beneficiaries over the age of 21. Now, if your beneficiaries are your grandkids, which you'll have soon, or if they're, you've got young kids like myself, then the trust can pay for all of their expenses because it's considered ordinary and necessary and crucial to their development, right? So it's necessary for their fundamental development to have food and clothes to wear and to be able to do fun things as a little kid. But for you as the trustee, it's not considered necessary. So that's where the 508c1a comes into play. So you take the same food, fun, and fashion, and whether you take money through donations or whether you give yourself a distribution, you have this money in here. It's 100% tax-free. And just like any other, church or association like this, that 508c1a can pay for any member-related expenses, right? So that's food, fun, and fashion, right? So if you and the wife want to go out to eat, it can pay for that. If you want to take the wife on vacation, it can pay for that. If you want to take the wife shopping, it can pay for that. So anything that we were missing before is now paid for tax-free. And what's more with this is your 508c1a, you can actually go and you can apply with the IRS for a 1023 letter. They give it to us every time, no problem, we qualify for it. And you can take that 1023 letter to the Secretary of State in Alabama and you can get a sales tax exemption, right? So now you're saving 10% on every single purchase that you make. And on top of that, and there's two ways to skin this cat here. You can do like Donald Trump did, and you can bury a dead relative on your property. And so now it becomes sacred ground. And so it's exempt from land taxes, and also no one can ever take it. But if you don't have a dead relative conveniently sitting around to bury on your property, then what you can do is you can go ahead and you can file that 1023, that same one you got from the IRS. You can file it with your county and you can get a property tax exemption as well. So I don't want to say that we can eliminate all the taxes you're ever going to pay for the rest of your life, but we can get pretty close. And so again, just to reiterate and kind of finish this off. So any assets that you have, so like if you hold any crypto stocks, anything like that, Those are all trust expenses. Obviously, gas for the vehicle, that's a trust expense. And then again, man, you're just stacking cash inside these two entities. And what you would ultimately want to do here is you would obviously want the life insurance on yourself, but you would also want to get life insurance on your wife and life insurance on your son as well, right? Obviously for the growth purposes, but eventually when they die, because the idea here is not for you to have all this and then just pass it to them when you die. The idea is, let's just say you're no longer in the picture, right? The idea, you know, whatever, 75, 100 years from now, you and the wife are no longer in the picture. Well, what you do is your son is the successor trustee. He takes over, and then his wife and his kids are now the beneficiaries. And so you're literally, and this is every single trust that we have here, you're passing this down to him. So you're not passing down your stuff, you're passing down the trust. So that's ultimately, man, that's A to Z, that's how it all works. Now, the very last thing, IRAs, 401ks, 403bs, those are all examples of what's called qualified plans. So the problem with a qualified plan, and what I personally don't like about it, is you're in partnership with the government, right? So that's for me, that's the, you know, that's where I'm like kind of hands off. So you can absolutely, for you, this would be a 401k. So you can absolutely, you can keep those 401ks in your name. You can keep them over here. Now, what we can't do, unfortunately, is we can't just move it into the trust because it's a qualified plan. The trust can't own it. It's attached to you. There's a couple of ways we can do that. We can take loans against it and we can use it to fund life insurance. And then we can, if you know, however you want to work that, let's just say you had 100K in a 401, same thing. You take a loan against it, you fund the policy, and then you take that money back out and pay the loan off. Now you have a policy. So you just turned $100,000 into a $2 million death benefit. That's huge. And again, just to reiterate on the life insurance, what that looks like, the policy owner is the trust. So it's a trust expense. And then the beneficiary of that is also the trust. So when you die, that death benefit gets paid back out. And the way that you make this work, right? So now your son, he's the trustee. What he would do when you die and he gets, you know, at years from now, that 2 million is probably going to be closer to 10 to 20. What he's going to do is he's going to take that and he's going to buy life insurance policies, probably another one on himself, and then on all his wife, kids, anybody who's involved with the trust. And so they're going to have that same thing. So then again, he's going to cycle out, right? You know, whatever, 150 years from now, however long, he's going to be gone. His wife is going to be gone. But then whoever, it could be all of his kids, could be one of them, whatever he chooses, he'll name them the new trustee, and then their kids will step in, and literally generation 1, 2, 3, 4, 5, 10, 100 years, 1,000 years down the line, you're still going to have this same thing going. Everything you set up, your family will still be using this. Then what you can do is you can just assign the policy over to the trust. Like you'll basically, more or less, it's a buy-sell agreement, but you'll just kind of sell it to the trust. And so the last thing is, in addition to this, when you do sell all these assets, you're selling them, right? So there's money to be exchanged. But what we do is we actually create a demand note. And let's just say you have $1 million in assets. The trust will issue you a demand note for $1 million. And then you can take money out of that demand note from the trust tax-free at any time, all the way down to that $1 million. So you don't have to, you know, that's again, like your food, fun, and fashion for beneficiaries over the age of 18 and all trustees. That's where you could pay for some of that stuff as well. But eventually, you know, whether it's for you or your son or your grandkids, eventually that $1 million is going to run out. So that's where the 508c1a really comes into play. Yeah, so the family trust can do donations. Typically, what we like to do, just because technically the family trust is the beneficiary of the 508c1a, we don't want to like muddy the waters, right? And we just want to say super like clean and out of the gray area with the IRS. So if we do a donation, we do it from the business trust. We get going today. All right, we take care of the payment and everything. And then what we do is we have an onboarding form and a strategy call to figure out what exactly assets you have, how all that's going to look. And then we'll create the trust. Typically within 3 business days, those trusts are going to be created and mailed out to you priority FedEx overnight, right? So you get those. And then from there, you're going to go straight to the bank. We recommend Wells Fargo because they're the easiest to work with. And we have a good relationship with them already. You're going to go to Wells Fargo. You're going to open your bank account and you're going to notarize the trust. They have notaries at the bank so they can notarize it, open the bank accounts, and also go ahead and after you notarize it, they'll scan it all in through their system and make digital copies and send you a PDF so you have a digital copy as well. Once you do that, strategy call with Miss Terry. We have a community and a full built out education and learning system, and we're actually partnered with a company called Infinite Wealth Strategy. I've been doing this for about 3.5 years. They've been doing it for 8. So we have access to all their systems, all their community. They've got loads of people, loads of coaches to like literally hold your hand and walk you through this start to finish to make sure you're comfortable and everything is done 100% by the book. You know, things like watching video courses and things of that nature, learning, getting into the education, really reading. And because one of the biggest problems is, so there's 5, this system we set up, there's 5 companies that I know of, including mine, that sell this. And what separates us and the other company we partner with, IWS, from everybody else is most people, they just drop you off here and they say, yeah, enjoy your trust, have fun. That's obviously not conducive to anything you're trying to do in terms of setting you up for long-term success and making sure that, you know, you can make this thing stretch 1,000 years if that's what you want to do. So there is a learning curve, but you can learn 100% at your own pace, right? So, I mean, you know, you could put 10 hours a day in like learning and, you know, like learn everything there is to learn in a few days, or, you know, you could do a couple hours a week and just as you go, knock out these milestones. It's the time commitment is as much as you need it to be. You'll probably spend like an hour and a half max at the bank. And that'll be the biggest time commitment other than, you know, talking to Terry for 30 minutes, talking to Kevin for, 30 minutes here, going over what do we want to do with the 401k? Is it currently structured as a self-directed IRA? Do we want a 1035? Do we want to take a loan against it? Whatever that looks like and whatever best fits your needs and goals, then obviously we'll do that as time comes, man. But like one option is 0% interest business credit. So what that looks like is, you know, you go through your LLC and then we would actually fund that LLC and you would get 0% interest credit for, let's say, between like 12 and 22 months is typically the you know, it's varies a little bit person to person and depending on what bank you're going with. But so we would stack business credit cards and those, again, 0% on those cards for the first 1 to 2 years. And then let's just say that 2 years rolls over and you haven't paid the 46 yet. You can basically kick the can down the road. You can go and most of these same institutions, they'll have an even longer 24-month term. So you would just balance transfer. That's no cost to you. Let's just say you got a $46,000 card and you paid it down to 20 over the next year. You would just balance transfer that last 20 on another 18-month card. And then let's just say over the next 18 months, you paid 10, right? And you don't want interest to kick on and you'd be paying, 18% interest. So you would literally just balance transfer that 10 again to another 0% interest card. And then you have another 18 months to pay the 10. So that's one pretty common way that we do it. Another common way is, people pull money out of 401ks, IRAs, things of that nature. Because you can get a certain, depending on, so like for like education and necessary expenses, you can get a certain amount of that tax-free now, even though you're not 59 and a half. So that's one way people do it. Life insurance, Some people just have loads of equity in their house. They'll pull a little bit out that way, or sometimes it's a combination of all three, right? So they don't get too stacked in one area. So we take every major credit card, every major debit card, wire transfer, crypto transfer, cash check, everything of that nature.